Thanks for clicking. All eyes were on Stats Canada this morning as it was set to release Canada's inflation rate for the month of June, with most banks predicting that our CPI would be in the 8 to 8.5% range, and 31% of respondents on this channel also predicting 8 to 8.5%. We got our answer this morning with June's inflation rate coming in at 8.1%, the highest level since 1983. The 8.1% inflation rate comes at a time when the Bank of Canada has just raised interest rates by 100 basis points, hoping to get a lid on Canada's growing inflation rate. With surging inflation and higher interest rates, predictions are growing that Canada is headed towards a recession, with others, such as ScotiaBank, saying recessionary fears are overblown.
Rumor.
Finance Minister Chrystia Freeland said on Sunday that despite Canada's inflation rate and rising interest rates, we can still engineer a soft landing.
But the Bank of Canada has been acting forcefully, and I think it is entirely reasonable to hope for a soft landing for Canada.
So what I want to do today is go over the inflation rate, look at those arguments like that of our finance minister saying we will be able to avoid a recession, then look at the counter arguments saying that we are indeed headed for a real economic contraction, and then take a look at what to look for next. We do plan on having our monthly mortgage rate update out next week, which will show how much mortgage rates have changed since this time last month. If you want to get those updates, make sure you click like and subscribe, but for now, let's get into this inflation rate. As mentioned, Canada's inflation rate continued to surge in June up to 8.1%. Judging from the report, gas prices had a fair bit to do with the inflation rate, as if we exclude them from the CPI, we have an inflation rate of 6.5%. So it's obviously not just gas prices, not just energy prices and the war in Ukraine that are causing our inflation rate to go so high. And I think anybody that's been to the grocery store can attest to that. So an 8% rate of inflation would have been unheard of 1 year ago.
Never happened, my friend.
It is undoubtedly going to put even more pressure on the Bank of Canada to raise rates at its meeting in September, which will raise even more fears of an impending recession. Yet some are not so sure that a recession is necessarily in the cards, with ScotiaBank recently releasing a report saying that Canadians' pent-up demand, Canadians' pent-up savings are still alive and well, despite all of the rate hikes, despite all of the increased cost of borrowing. Scotia says that despite the Bank of Canada's best efforts to restrict the money supply, Canadians' pent-up savings are causing them to still visit restaurants, which are seeing a 20% increase in the amount of diners since 2019, and Canadians are still traveling, as the number of passengers screened have been rising rapidly even with the rate hikes coming to bear. Scotia says that when economic conditions get tight, Canadians are most likely to stop eating out and to stop traveling, so the fact that they're still continuing to eat out and they're still taking trips is an indication that they are putting those savings to use even with the higher cost of borrowing.
I talked to them a million times. They don't listen.
Indeed, TD was warning in November that Canadians had amassed nearly $300 billion in savings during the pandemic, and that huge stockpile of savings would cause a real problem for the Bank of Canada as they tried to constrict the money supply vis-a-vis interest rate hikes. You can raise the cost of borrowing all you want, but if Canadians have a pile of cash, they are still well able to spend, which will put continual upward pressure on Canada's inflation rate. So while Scotia is pointing to the evidence that Canadians are still continuing with their discretionary spending despite the higher cost of borrowing, others are pointing to the low unemployment numbers and the continual positive job numbers as signs of the strength of the overall economy. As such, Scotia says that Canada's GDP will grow by 3.5% this year and slow down but still grow by 1.6% next year, narrowly avoiding a recession. With all of that said, others are arguing that it's just a matter of time before these rate hikes cause a slowdown in spending. As the cost of borrowing rises, consumers will spend less, businesses will hold off investment and freeze hiring, which will provoke a spike in unemployment. One Toronto contractor said he's already seen a 40% drop in the number of inquiries and noted similar stories from his colleagues in landscaping, pools, and painting. As such, BMO economist Robert Kravchuk recently noted that we can see the construction component of Canada's GDP reducing as we speak, with the housing market constituting 8.5% of Canada's GDP over the past few years. A real reduction in that market will put real pressure on the rest of Canada's economy. As these painters, landscapers, pool experts, finish the jobs that they already have booked. When they don't have new jobs coming in, new jobs to be completed, we're not going to see this impact on our GDP right away, but give it 3, 4, 5 months, and these experts are saying we'll start to see a real impact in our overall GDP growth numbers. And let's not forget, it's not just the Bank of Canada that is pulling the money back. A recent study by the U.S. Federal Reserve said that the stimulus in the U.S. throughout the pandemic contributed to Canada's inflation rate by as much as 2.3%. And it's not clear that that stimulus from the United States is coming back either. And the U.S. Federal Reserve is also raising interest rates. They're set to raise by 75 basis points. So we're already seeing a major contraction in the money supply from our biggest trading partner in the United States. And this is going to put even more pressure on Canada's economy going forward. So, in summary, 8.1% inflation rate in Canada, less than the 8.4, 8.5% that was predicted, but still definitely not great. In fact, if this was a year ago, people wouldn't be celebrating that we were 30 basis points lower than anticipated. 8.1% is still nothing to shake a stick at, and the 6.5% that we would have without the gasoline component shows that it's not just energy prices that is pushing up that inflation rate. There are some positive signs that Canada might be able to withstand the interest rate hikes that are coming down from the Bank of Canada, as we do have a savings glut and Canadians are still spending. However, it does take time for these interest rate hikes to filter their way through the economy. So while Canadians are still spending now, we're starting to see a real slowdown in the housing market, not just real estate sales, but in the construction portion of the housing market, which definitely constitutes a major portion of our GDP and could put major downward pressure on the rest of our economy. And it's looking more and more likely as though these interest rate hikes are going to continue, which will obviously put even more pressure. So whether or not Canada will enter into a recession remains to be seen. However, evidence is mounting that it could be a bumpy ride ahead, with inflation over 8%, interest rate hikes showing no signs of slowing down, and we're already seeing the results of these hikes filter into Canada's housing market. It will only be a matter of time before it filters into the rest of the economy as well. We'll obviously have updates out on the effects of those interest rates on this channel. If you want to get those updates, make sure you click like and subscribe, and thanks so much for watching.